Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Brian Spear, co-founder and principal with Sunrise Capital. Anthony, what was a takeaway or two that you had?
Well, for one, we talked about a very different asset class.
Mhm.
And what he talked about investing in mobile home parks and parking lots. And at first glance, somebody were to say that to me, that doesn't sound that enticing.
You don't hear dollar signs when you
No,
when
well,
you hear
with
that?
parking lots, I do.
Mm,
Parking lots, I see dollar signs, but with mobile home parks, there's other signs that are popping in my head. But he conveyed a very different approach. That it's not the stereo typical. And I tell you one thing, I really liked what he said, and he said it multiple times. And at first, when he said it, it gave me like a little angst, like he was swearing. Okay,
Oh no.
right? I know. And
Oh.
he said, "We don't live on a spreadsheet."
Oh, I could
I
see
mean,
how
do you know?
yeah.
I mean,
Yeah.
I don't live on a spreadsheet, but all my life is on a
Yes,
spreadsheet.
yes, you do. Yeah.
But all jokes aside, that is, I think, a common issue people have, where we think we live on a spreadsheet, where we're so focused on the numbers.
Mhm.
And we need to really figure out what our goals are, and ways to get there, and not be so focused on the numbers, but focus on the lifestyle that these numbers can provide. Cam, any takeaways that you had?
Yeah, one of the you alluded to it, but I'm going to reinforce it here is that he opened with one of the biggest misconceptions around mobile home parks.
Mhm.
I grew up in North Idaho. We had plenty of mobile home parks around, and the stereotype was mainly true, to be
Mhm.
honest.
Mhm.
But what he talked about is typically you think about kind of trailer trash and just not kind of upper end of living lifestyle. But he said that's not true, right? Especially to their portfolio, that there is some opportunity there. And so that was surprising to me. One of the things that he shared was sticky tenants. And he said that, man, one of the tenants has lived in that park for almost 50 years, which I thought was very interesting. But again, great interview by Brian Spear. Again, he is principal and co-founder of Sunrise Capital Investors. Brian has been helping high net worth investors better understand the world of alternative investments for almost 15 years now. So we enjoyed this interview. Hope you guys do too.
Enjoy the episode.
Take care. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. Today we've got a special guest, Brian Spear with Sunrise Capital Investors. Brian, welcome to the show, man.
No, welcome. Thank you very much for the invite, bud. Looking forward to jumping on, talking shop, and trying to add as much value as possible along the way.
Hey, we're excited to have you. We've got a bunch of questions for you. Before we get into the meat of it, I've got one for you. For our listeners, is one of the biggest misconceptions that there is around investing in mobile home parks and or parking lots.
Well, I'll go into mobile home parks here. That's kind of how we cut our teeth for the last 15 years, and it's really interesting because for the first decade of our investment career in this asset class, nobody was really bragging about owning mobile home parks around the water cooler, right? And a lot of it is associated with this crazy stigma associated with trailer trash and the like, et cetera. I think folks would be truly shocked if they actually see the quality of the residents that we have throughout the portfolio. Granted, there are some different mobile home parks that are a little bit more downtrodden than others, but that is also the same. The same can be said inside of the multifamily sector, right? So, in the mobile home park sector, properties are rated on a scale of a 5-star scale rating. So from 1 star to 5-star, where 1 star is kind of the old drug, sex, and rock and roll trailer park, as it were, right? It's the stuff that everybody sees on TV. And then
Yeah.
5-star, it's like a manufactured housing community where it's 55 and over. Everybody drives a golf cart. It's a 3-bed, maybe a 4-bed, 2-bath, 2-car garage attached, and so on and so forth. On Fridays everybody plays bingo, and there's all sorts of crazy amenities, etc. And they run the gamut everywhere in between. But there are literally tens of millions of human beings throughout this country that reside in mobile home parks because it is the best, most unsubsidized, affordable housing in the country. It's just oftentimes the best option for a litany of folks. Um, so I would say that that unfortunate trailer trash stigma still persists today, but I think it's something that really it's going to be hard to completely remove that from the psyche of America because it's just so commonplace, right? You see trailer park boys and you see cops. It's always, you get the one-star folks all the time. But the truth is really a far cry from that. I think really folks would be shocked if they saw the quality of the homes inside of a lot of the communities that we own throughout the country. I'd say one final piece beyond that, a lot of times folks that are just getting started, in various different niches in real estate, vetting different asset classes, they might be turned away from mobile home parks because they might feel or believe or think that the residents are, poor, destitute, downtrodden, etc. But the truth is, there's significantly less turnover than that which you might think. Our residents are actually extremely sticky. The longest tenured resident in one of our mobile home parks has been there over 45 years. I mean, name the multifamily property where somebody's been renting for 50 years. It just doesn't happen. And the reason it happens in the mobile home park sector is because once they own their home outright and they're only paying lot rent, which is just a few $100 a month. I mean, where in a first world civilized society can you live for $300, $350 a month? And for that reason, once they're at that level, they basically never leave, which makes their income very sticky, very stable over long periods of time.
Awesome, man. Thanks for sharing that. I made a couple notes. We might circle back to that, but I know you've been in this space for a while now. How did you get into kind of the space that you're in?
Yeah, so we've been really fortunate, right? We've owned mobile home parks now in 18 different states, gone full cycle on 15 different deals, and just done a lot of different crazy things inside of our asset class. But my very first experience with mobile home parks was when I lived in one when I was 10 years old. So my parents got divorced when I was 10. My dad moved to Gary, Indiana during the 1990s when it was known as the murder capital of the world. And then my mom moved to a mobile home park on the south side of Chicago. She moved into a single wide with her best friend for a period of time until we could scratch and claw enough of a down payment together to buy a double wide on the other side of the mobile home park, right? And that was my intro, my foray into the
Mm,
mobile home park
Mm.
sector. So again, I have a different perspective of the residents that we provide affordable housing to because I was one such resident on the other side of the table many moons ago. And I just knew from an early age, I was going to do whatever it took to ultimately put my family in a better financial situation, decades down the road. And ultimately, after college and getting a business degree, I knew that I was going to get involved in the world of investing and found my way back to mobile home parks because it resonates with me. And it's truly the definition of a successful business model where it benefits everyone in the stakeholder chain. Again, my mother, she wasn't, a poor, downtrodden, a ridiculous resident. She actually has a degree from a Big Ten institution in accounting from the University of Illinois, which is one of the best accounting degrees in the country. She'd just fallen on hard times economically, and it was the best decision for her and her few children at that time. So, for us, it's more than just making a little bit of money and ultimately having another zero on the income statement or the net worth. Really, it's about just being able to try to help as many people as possible generate cash flow and build legacy wealth in a tax efficient manner. Because that's what I'm trying to do for my family, my kids, and we're going to help out as many people along the way as we can, including all the residents along the way. It's the best option available for them. So, yeah, all good, man. That's how I got started.
Well, so what all does Sunrise Capital do, Brian?
Basically, we're a mobile home park investment company. I'd say considered best in class, one of the best in class. We work with accredited investors to help them generate cash flow and build legacy wealth in a tax efficient manner, where we basically pool capital together in a fund structure, right? Raise capital. Pool capital together in a fund structure. The fund structure goes out and buys real estate. The real estate generates profits, and then we share in the profits with our partners. That's it in a nutshell. So our business model, it is a light value add business model where we always do our best at the very outset to try to buy deals with a really nice margin of safety right at acquisition. So this typically means doing an exorbitant amount of off-market direct owner marketing, cold call campaigns, direct mail, these sorts of things to try to drum up deals that have a nice margin of safety right at acquisition. Buying from somebody who either needs or wants to sell. That's typically what we're looking for. And then once we buy the deal, we have a light value add business model, which typically takes us maybe 18 to 24 months on average, sometimes a little bit longer if it's a heavier lift, might be 4 or 5 years if it's a really, really heavy lift. But we operate a buy, improve, and hold business model. For many years, we were doing a buy, improve, and sell model. But as we've grown, evolved, I think improved our investment philosophy has become to buy and hold everything because this asset class has the highest same store NOI growth out of any respective real estate sector. So that's just, again, fancy way to say best compound interest. So we know over very long periods of time, the asset class is likely to do well.
Well, you got my bells ringing a little bit when you said tax efficient. So, but so explain. Can you expand on that?
Yeah, so from our perspective, we're trying to be as holistic in our tax strategy as possible. It means from the very outset and then throughout the entirety of the holding period. So um, another one of the misconceptions about mobile home parks is that folks sometimes don't know. They might think that you can't depreciate a lot of that asset, right? So a lot of people investing in real estate, one of the benefits is you get a lot of depreciation that
Yeah.
offsets your passive
Mhm.
income along the way, right? And in the mobile home park sector, folks are often if they're unaware, they're shocked to realize that mobile home parks are remarkably tax efficient. They're typically about 2 to 3 times more tax efficient than multifamily and maybe some other real estate sectors. By way of example, somebody that invested in our most recent fund in 2023, that invested $100,000 by way of example, received a passive loss in their K1 of $135,000. So if you could take that phantom loss of 135,000 bucks and offset your other income, you could literally save on after-tax cash on cash returns tens of thousands of dollars year one. And I haven't even begun to send outbound distributions from the cash flow that the assets throw off, right? So they're remarkably tax efficient at the very outset of the respective investment. And then the manner in which we've structured our business is again holistic to try to help you keep as much of your hard-earned money in your pocket along the way as we possibly can, right? We do a buy, improve, refinance, and hold business model. So buy a deal with a nice margin of safety, improve the asset, once we've stabilized the deal, then we'll do a cash out refinance. A lot of guys typically sell the deal here. We've done that on numerous occasions. We've now, what we like to think, we've seen further than others because we've done it a bunch. We realize the better option is to ultimately just do cash out refinances, get all the chips off the table in a non taxable event. Because again, you don't pay tax on a cash out refinance because it's debt. And fortunately, the residents truly are the ones paying back that respective debt over time, not you, right? So we pull that capital off out of that respective property via cash out refinance, get the chips off the table. From that point forward, we like to say we're on an infinite cash on cash return because we've gotten all that investment back. And then we just continue to enjoy the cash flow that these assets throw off over very long periods of time. So again, that's a very, very, very tax efficient way
Mhm.
to manage capital and try to drive returns on behalf of investors, in my humble opinion.
Brian, in that example you had mentioned, they put in invested 100, had a loss of the K1 of 130. What is triggering that loss?
Yep. Great question. So you guys are likely familiar with the Tax Cuts and Jobs Act of 2017. When that
Mhm.
was enacted, it allows for really high quality accelerated bonus depreciation. So if I look at big buckets of different real estate sectors, typically commercial real estate is 39-year depreciation schedule. Residential real estate, multifamily included, is 27 and a half year depreciation schedule. But when you're buying a mobile home park, what are you buying? It's not really considered commercial. It's not really considered residential. What are you really buying? And the reason I say it's not really considered residential is because when we buy a mobile home park, we don't like to own the homes. We're really just buying the land. And if we want the residents to own their own homes and then just pay us lot rent. So what are we buying? If we buy $1 million mobile home park, what are we buying? You can't depreciate the land. And a mobile home park, it's about 20% of the purchase price is typically the land. What's that 80% then? So what would the $800,000 in that example be? Well, in that example, the vast majority of that purchase price is associated with the roads, the curbs, the gutters, the underground infrastructure, the utility lines, and all of that infrastructure is considered capital improvements, which is on a 15-year depreciation schedule. And because of the Tax Cuts and Jobs Act of 2017, all of that can be accelerated via accelerated bonus depreciation into a much, 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 much shorter horizon. For many, many years, 100% of that could be depreciated in year one. That's slowly dwindling down over time. This year, it's ultimately, I believe, 60%, and it'll continue to dwindle depending upon who wins the election and ultimately if this gets extended beyond 2026, I believe. But that is largely why we're already on a much shorter schedule, right? 15 years is a heck of a lot shorter than both 27 and a half and 39. But with the Tax Cuts and Jobs Act, anything that was 20 years or shorter can be accelerated into year one. A portion of it, at least, can be accelerated into year one, which makes it just ridiculously profound in terms of their tax efficiency.
Brian, you brought up a good point of that Jobs Act is set to expire next year. So whoever is in Congress and in the White House is going to make some big decisions on what's going to happen to the taxes, as well as Obamacare is set to expire as well. So there's these next 2 years are going to be extremely important for investors and for the economy. Brian, I'm glad you shared that because I saw you speak at a conference in Tennessee, and you had mentioned the depreciation, but I knew you didn't buy the homes, but I was wondering where that depreciation came. So
Mhm.
thanks for explaining that.
Yeah, of course. No, it's again, even guys that are deep in the weeds. Again, when you're talking about IRS code, you're pretty deep in the weeds. You know what I mean? So,
Yeah,
not a lot of folks understand that piece of it as granularly, buddy. So all good, man.
it's
Very
okay.
interesting.
It's okay. It's okay.
Brian, you mentioned the tax advantages being one of the advantages of kind of mobile home park investing through this fund. Are there any disadvantages to this model?
Of course, I mean, in any respective investment, there's always risk associated with it, right? So there's a million different ways to skin a cat in real estate investing, right? So from our perspective, we like to think that this is the best respective business model for a litany of reasons. We just feel like it ultimately helps people achieve real financial freedom, right? The investors turn to Sunrise when they're frustrated with the crazy stock market and the Wall Street casino, and they're trying to find a way to get passive income for them and their families. They're searching for that truly passive income so that they could kind of buy more one-on-one priceless time with their families, even if they built a gigantic pile of cash, right? They realize that money doesn't buy happiness. They just want more time to do what they want to do. But if you're on a business model that is a buy, fix, sell model, in my humble opinion, then you're always still buying yourself a job. You're not genuinely generating long-term passive income into perpetuity. So we have a very, very simple business model, right? Buy and hold. Don't ask us to do a fix and flip, a 2 to 3 year fix and flip, because we're not interested in doing that. There's better choices if you want to take that much risk. So what's the upside and the downside? The reason that I bring that up is that when you look at a spreadsheet and you look at the buy, improve, and sell business model, if I were to compare that spreadsheet to our business model and our spreadsheet, the highest internal rate of return would be the point at which the NOI growth is accelerating at its highest rate. And when you get to stabilization, then the tapering of the NOI growth kind of tapers off over time, right? But we want to continue to hold throughout that period of time. If your goal was exclusively to try to generate the highest internal rate of return based on a spreadsheet, then you would sell the asset immediately upon stabilization. And we've done that on numerous occasions. Like I said, we've done 15 full cycle deals with over a 40% internal rate of return across the board. That's phenomenal. Like we've done that. We understand that. However, from our perspective, we've come to realize that the real world doesn't happen in a spreadsheet. And when you do that, it creates ripple effects and problems for everybody involved. Some people who want to do the buy, fix, and sell model because they're convinced that that's the best way. Again, that wouldn't be a good fit for our team, for what we do. So again, that's a downside, as it were, from that perspective. But um, we feel like it is an improved and better business model because there's a significantly higher amount of risk associated with a buy, fix, and sell model. Why do I say this? There's a million reasons why, but the most important is time. There's nothing that you could possibly do to completely de-risk an investment, right? Anytime you make an allocation of capital to source some sort of investment, right? There's some level of risk. My job is to try to generate outsized risk adjusted returns. The return that I'm going to receive is over and above the amount of risk I'm taking. And one of the biggest risks associated with any respective investment is uncertainties in the economy. You never know when the next black swan event's going to occur, or hurricanes, all this crazy stuff that could pop up at any respective time. So if you have, however, if you have a long enough duration of time, a long enough hold period, a lot of those things kind of fall out over time. So even if you bought a great deal, a good property, you buy it right, you implement the business model right, you do the buy, fix, and you're about to sell the asset, but you just happen to be selling that deal based on your pro forma saying, I'm going to hold it for 3 years at a time which is horrific based on the next black swan event, COVID, the great financial crisis, whatever it could be. If you had to sell at that time, well, you're putting yourself, your family, and all your investors in a very precarious situation. And so our philosophy is to remove that element of risk, which is time, from the investment and allow time to do its thing, especially if you're buying in a business model that has ridiculously profound macroeconomic tailwinds, right? We've got insatiable demand for our product. Our product's affordable housing. It's just massive through the roof. And there's no new supply coming online, which means over very long periods of time, the asset's going to continue to outperform. So from our perspective, why would we ever sell? So time is a huge risk. And then beyond that, right? If you wanted to do that, the argument for folks would be, well, I'm going to skip from one asset to another asset, just keep doing 1031s where I'm getting the highest IRR. Then I'm going to 1031 and try to get the highest IRR and try to get, but life doesn't happen in a spreadsheet. Multiple points to make here. One, the exact inverse time of the best time to sell is the best time to buy. So if you're selling an asset, you're only going to really do that if it's a good time to sell the deal. And then it means it's not really that good of a time to buy, but you would be forced to, and you'd be forced to do it in 45 days if you're trying to do a 1031. And the 1031 doesn't even really save you, because folks that think that they're going to get out of Uncle Sam's, skirting all the taxes, it really doesn't save you, because you still have to pay depreciation and recapture tax. You still have to pay 25% depreciation recapture tax, even if you're going to do a 1031. So, from our perspective, a buy, improve, and hold model where you basically get all your chips off the table after a reasonable duration of time. You take that original investment amount, you invest in another asset, you create multiple different streams of income off that one original investment dollar, and just allow time to do its thing. In my humble opinion, it's the best way to generate the best risk adjusted returns and finally find a way to go buy time with your family. This is my 2 cents. That's the way I see it.
Awesome. Thanks
Well
for
said. Yeah.
going deeper into that, Brian. Are you able to share some of like expected returns or
Yeah, I mean, happy to give you some color. I mean, we try do our best to try to under promise and over deliver, right? We're never perfect. We never say that we are. But if you wanted to know more about our particular fund, what we always share is that we project out somewhere between a 7 and 8% cash on cash return annually, and somewhere between a 14 and 18% annual rate of return on that respective fund. That's the projections that we have inside of our current investment that we have available today. So. Um, Again, it's a crazy world out there, and there's a million ways to skin the cat. But we feel like this is, for my money, my family's money, hell, the vast, vast, vast majority of my family's net worth is invested in the asset class, because we just feel like it's got the best risk adjusted returns in the marketplace.
now, Brian, you guys are going in and getting a loan potentially, right? To
Mhm.
buy to buy this mobile home park. And are the terms of the loan, are those a short window, or is there
Mhm.
how's that amortized? How long is that
Uh,
loan?
Yeah, great question. So, I'll just talk like our debt strategy as a
Yeah, yeah,
whole. In a
yeah.
perfect world, of course, every deal is a little bit different, but in a perfect world, what we try to do is keep our LTV across the fund somewhere maxed out at maybe 60%, typically right around that range. We never want to get out in front of our skis from a debt perspective. On any given individual deal, we might go up to 65, 70, maybe 75% on, an ad hoc basis if we get ridiculously profound, maybe seller financing, something like that. But we do negotiate these deals and their debt individually on a case by case basis. It's not like we've got a gigantic agency facility for multiple nine figures, et cetera. Every time we buy a new mobile home park, we go out and we put the best individual bank financing on that deal at acquisition. And what we try to do is the following: we normally don't like at acquisition to get life co debt, agency debt, CMBS debt, because it really does lock you in for a really long period of time. We do like long-term fixed rate financing. We're not the kind of guys that are going to do bridge debt, et cetera. Like I said, we're trying to remove as many of the risks as we possibly can along the way. So what we like to typically do, because we've got a value add business model, a light value add model, we haven't extracted all the value at acquisition, is we like to get flexible terms when we buy the deals. So what we'll do is we'll go to regional or national banks. We'll look to get a loan with either a 30-year amortization, maybe 25-year amortization, and they'll typically give us a 10-year term. Sometimes they might only give us 7 years. Sometimes they might only give us 5. But we always try to shoot for a 30-year amortization, 10-year term on these respective fixed rate loans. And then what we do is we try to negotiate down a prepayment penalty, right? Where we'll look to negotiate down a 210 step down prepayment, something like that. Where in the first year, we might have to pay a 2% penalty if we replace the debt. In the second year, we might have to pay a 1% penalty if we replace the debt. But starting in year 3, then we'd be able to do a cash out refinance whenever we would like, all the way through the rest of that term, anywhere from year 3 to 10, and just do a cash out refinance when market conditions warrant, instead of kind of having a forced liquidity event, because that's what ultimately gets guys in hot water. It's
Mhm.
why the buy, fix, and sell with that bridge debt model is so risky, because you basically have to replace the debt in 2 or 3 years, no matter what's going on in the economy. And that's why a lot of guys, unfortunately, are running into some precarious situations right now. Um, so anyway, that's the philosophy. We'll have that style of national or regional debt on at acquisition, again, in a perfect world. And then when we stabilize the deal, go back to do that cash out refinance. That's when we put the long-term permanent fixed rate financing on with an agency and the like.
Great, Brian. Thanks. Before we start recording, right? Obviously, we talked about a lot about mobile homes here, but you also mentioned parking lots. How long have you guys been in that space, and why did you guys venture out?
Oh, dude, I love parking. Yeah, so we've been doing it now about 5 years. We've been in this business just in general for about 15 years. Bought our first mobile home park in 2011, and we were on the hedgehog model for almost a decade. And then ultimately, once we got our companies such that we basically had a flywheel, we have a vertically integrated property management company, et cetera. So anytime we bought a new mobile home park, it really didn't adversely affect the machine. And when we got to that point, we were comfortable exploring additional asset classes that would be complementary to what we're already doing. So we looked at our skill set, what we do very well, and sought out other asset classes, and ultimately landed in parking for a litany of reasons. Feel like it's still ridiculously fragmented. There's really, I genuinely don't know of anybody else that's out there doing what we're doing in that asset class, right? Again, we felt like we were ahead of the game in mobile home parks a decade ago. Nobody's bragging about owning them around the water cooler, and really, I don't know anybody out there doing what we're doing in parking either. Um, it's just very, very fragmented. We always look for fragmented niches, because if you're in a fragmented niche, oftentimes you can have a significant bid ask disparity, and we like to have that because my business partner has been negotiating off market direct owner transactions for 25 years. He used to be doing it in single family back in the day, and if I could put him in a phone booth with the seller of an asset, and there's nobody else, no broker involved or nobody else to be around there. And let's say he wants to sell it for 10 million bucks and we want to buy it for 6. Well, typically we could find a way to buy a deal with a really nice margin of safety right at acquisition. So parking has a lot of these similar characteristics to that which we find in the mobile home park space. Both of them are considered cash flowing covered land plays. I would pose to you, you guys have heard the term, right? Real estate's all about location, location, location. I'd pose to you that you would be hard pressed to find a better location than a parking lot. Somebody's literally willing to pay you just for the right to stand on the parcel of land that you own. And again, some of the assets that we own are in just ridiculously phenomenal, profound locations. By way of example, we own Lore's City Center, which is in downtown Phoenix. It's 1 block away from the Phoenix Suns Arena, 2 blocks away from Chase Field, where the Diamondbacks play. It's right across the street, a stone's throw from Maricopa County Courthouse, the fourth largest courthouse in the country. And when you're in a state capital, state capitals don't change for literally generations, centuries. So the
Yeah.
demand is likely to be there for very, very, very long periods of time, right? So I could keep going, but suffice it to say, there was so many different overlaps between mobile home parks and parking that we really, really love. That in the again, a cash flowing covered land play just simply means that the cash flow in the interim period of time covers the carrying cost. We get a little bit of nice cash flow along the way, and the land play suggests that over very long periods of time, that underlying land value is very likely to continue to increase again over very long periods of time. The first millionaire, the first multimillionaire in this country is a gentleman by the name of John Jacob Astor, and he basically owned a bunch of land on Manhattan when he first came over. And as you can imagine, right, if he just retained all that land, how ridiculously wealthy him and his family would continue to be, based on just the location alone, as that characteristic. So a lot of reasons we love him, man. That's just a few.
Perfect. Brian, who would you say that your fund is for? Like, who's like the ideal person could fit?
No, I mean, from our perspective, we work with a lot of different types of folks over time. But like I said, genuinely, it's people that are typically trying to buy back time with their families. Um, Folks that are trying to generate cash flow and build legacy wealth in a tax efficient manner and appreciate a long term buy and hold type of strategy. We are ardent followers of the crazy, Charlie Munger and Warren Buffett, and we try to implement their tactics in our real estate sector. For those unaware, Warren Buffett's the biggest player in the mobile home park space. Most folks don't know that, but he's the biggest manufacturer of mobile homes in the country. He is uh, he's the largest lender on mobile homes in the country through his company Clayton Homes and through his company 21st Mortgage, and he is the second largest lender on mobile home parks through Berkadia, which is a subsidiary of Berkshire Hathaway. So I mean, we just try to implement so many of his philosophies in our business model. So if you appreciate what he's historically done, by no means are we perfect, but that's what we're seeking to do in the asset class.
Brian, love it, man. Thanks. We've got a couple resources that you mentioned beforehand, a few ebooks, or at least one, right?
Yeah. So we have a passive investing guide to mobile home parks. For folks that want to go check that out, you can head to sunrisecapitalinvestors.com/MHP. It'll get you a little bit more insight on the crazy world of mobile home parks. And if you want to dig into parking, you can go to parkinglotprofits.com. And then I'd say last but not least, if you just want to learn about our fund, we would respectfully request that you head over to investwithsunrise.com. That's basically all the goodies out there for you guys should you have an interest in learning more along your investment journey.
Brian, we will have those in the show notes. Brian, is there any question we didn't ask or anything you want to share before we wrap this up?
No, you guys crushed it. I mean, golly, I think you hit all the salient points, man. I got nothing else for you. Life is good. I'm all ears, man. If you got something else you want to dig on.
No, that was great, and this was very interesting because this is the first one we've had on
Mm-hmm.
mobile home parking, and definitely in parking lot. So
Mhm.
hopefully for our listeners, we've kind of planted another different asset class that maybe that you didn't think of. So the next step would be to do some due diligence, and so we will have those links in the show notes. And Brian, thanks again for coming.
Yeah, man. Thank you. Appreciate you.
Yeah, my pleasure, guys.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.